This voice is taken from an article with the title, "What is the Impact of Government Debt on Currency Values?" which has been published on TraderTalks.net. The impact of government debt on currency values is an important factor to consider when trading in the foreign exchange market. Government debt is the total amount of money owed by the government to its creditors, i.e., people and companies who have loaned money to the government. When government debt increases, it can put pressure on a nation's currency and lead to depreciation in its value. The primary reason for this is that an increase in government debt can weaken a country's creditworthiness and make it more expensive for the government to borrow money. This can lead to a country having to pay higher interest rates on its debt, which can lead to higher inflation and a weaker currency. Furthermore, when a government's debt increases, it can reduce its ability to invest in other areas, which can lead to a lack of economic growth. This can also have a negative impact on the value of its currency. Government debt can also have an impact on currency values if the government decides to use its currency reserves to finance its debt. This can lead to the government selling its currency in order to buy foreign currency, which can lead to a decrease in the value of its own currency. Additionally, if a government has to increase taxes to finance its debt, this can lead to lower consumer and business spending, which can also have a negative impact on a currency's value. Finally, it is important to note that government debt can have an impact on currency values depending on the type of debt that a government has. For example, if a government has a large amount of short-term debt, then this can be a sign of financial instability, which can lead to a decrease in the value of its currency. On the other hand, if a government has a large amount of long-term debt, this can be seen as a sign of stability, which can lead to an increase in the value of its currency. In conclusion, it is important to keep in mind that an increase in government debt can have a negative impact on a currency's value in the foreign exchange market. This is because an increase in government debt can lead to higher interest rates, higher inflation, and a weaker currency. Furthermore, if a government uses its currency reserves to finance its debt, or increases taxes to finance its debt, this can also lead to a decrease in the value of its currency. Finally, it is important to note that the type of debt a government has can also have an impact on its currency's value.